Hey everyone, welcome back to another dividend investing video. Exchange traded funds, or ETFs, are a popular and easy way to get started with investing. And in dividend growth investing circles, there's no more popular and beloved ETF than the Schwab US Dividend Equity ETF, ticker SCHD. Every day, another SCHD video pops up on YouTube, and its popularity exists for good reason. But today I want to take a look at some of the other great dividend-focused ETFs that are available for investors. There are some solid ones, and I've narrowed it down to 3 of my favorites, so let's get to it. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. If you don't know what an ETF is, think of it as a collection or a basket of stocks. Instead of buying individual companies, you're buying a set of stocks, and this usually follows an index. This provides an affordable way to get instant diversification, which is why they're ideal for getting started with investing. Now, as dividend growth investors, we all love SCHD unanimously for what it does and what it has done since its inception in 2011. We have a 3% plus yield with double-digit dividend growth. And even finding individual stocks that do this consistently is not easy. Now, here in the last couple years where there's been a bear market, SCHD has acted as something of a hedge. It's outperformed the S&P 500, and this is what you want out of a good dividend ETF. It's what you expect, right? Reliable income with less downside than what you'll be getting when you're investing, say, out of the S&P 500 or a total stock market index. Now, one thing I want to stress is that past performance does not necessarily indicate what is going to happen in the future. We don't know that SCHD will continue to perform this well, and this is one reason I think it could be wise to spread your investments among a few other ETFs if you are choosing to go the ETF route, which I'm finding it seems more and more investors are choosing to go the ETF route. And while I'm personally investing a significant amount of my investments into SCHD right now, I'm also buying other ETFs as well. Now, I have some simple criteria I had when making this list. I'm looking for a yield that beats, VOO, the S&P 500, because we're looking for dividend-focused ETFs. That's dividend growth and dividend income, either one. I want a 5-year dividend growth history, at least 5 years. And I want a low expense ratio, 0.1% or less, ideally less. The lower, the better. So let's get to it. These are 3 amazing dividend growth ETFs, not named SCHD. I'm going to use SeekingAlpha to evaluate these ETFs. I'm using a premium membership, and while they offer a lot of great features for free, going with their premium membership unlocks even more features and allows access to all the articles written by these fine, reputable authors. SeekingAlpha has partnered with my channel and is a special offer for our viewers and subscribers. If you use the link in the description of the video, you can sign up for a free trial with SeekingAlpha. And if you decide you want to keep it, you'd pay only $99 for your first year, and this comes out to about $8 a month. And speaking as a user of the site, I think it's an excellent value, and it's a great way to help support the channel. At the end of the video, I'm going to put all these ETFs up on a chart with both SCHD and an S&P 500 index. With some of SeekingAlpha's features, you'll see just how easy it is to compare all these nicely in one place. The first ETF I like as an alternative to SCHD is the Vanguard High Dividend Yield ETF, ticker VYM. VYM tracks the FTSE High Dividend Yield Index by using a full replication technique. Year to date, shares of VYM are down about 4%, and over the last year, shares are down closer to 9%. This is a few points better than the S&P 500. So this outperforms the market during a downturn, and that's what we want to see in a dividend ETF. We understand that in a bull market, we're likely not going to meet market returns in exchange for that sweet dividend income. We will look at the longer term performance of all 3 of these stocks together at the end of the video. Expense ratio is just 0.06%. What this means is for every $10,000 you have invested in VYM, you're going to be paying $6. It basically comes out of your dividend payment. Now let's look at that dividend payment. SeekingAlpha gives us a dividend grade of A+. We have a dividend yield of 3.24 based off the last 12 months at least. Over the last year, it paid out $3.31 per share. And in terms of dividend growth, the dividend paid out by VYM has grown at a rate of 6.61% over the last 5 years, and the dividend has been growing for a solid 12 years. Its last payment is this last week here on March 23rd, in the amount of 72 cents per share. I just received my VYM dividends and reinvested them right back into the fund. This pays out in the months of March, June, September, and December. Now here is the dividend yield page on SeekingAlpha. First, this Nice chart, shows the historical dividend yield. And look, back at the crash in 2020, that was a huge opportunity. But if we move this out to 10 years, we can see that only a few times have we've been able to get VYM at a yield above 3%. That really speaks to how far some of these stocks in there have dropped. But going by this chart, I see a fund I would prefer to grab when it's above that 3% yield. The next graph here shows the yield on cost. If you had purchased VYM 10 years ago, your dividend paid out would be over 6% of your initial investment. That's excellent for a diversified ETF that follows the dividend index after a couple years of a bear market. And then we can see its dividend history, and its average tends to be right below 3%. So not to sound like a broken record, but if you can get VYM above 3%, historically you've been doing quite well. Now here's a chart of its dividend growth history. In 2013, you'd have made $1.73 on your shares for each share, while last year you'd have gotten paid $3.25 per share. And that is a great illustration of dividend growth. Gotta love it. Another look at this payout history. Notice this 5-6% jump we got this last month compared to March of 2022. So VYM is off to a fine start for the year of 2023. Here is a look at the holdings breakdown by sector. Financials gets the highest weight at 21.28%, followed by healthcare at 15% and consumer staples at about 13.5%. Industrials and energy each make up about 10% of VYM. And notice, just like SCHD, no real estate exposure, no REITs. Now here are the top 10 holdings in VYM at the time of publishing, and it looks to be weighted by market cap. ExxonMobil takes up the largest portion of the fund at 3.26%, followed by JP Morgan Chase at 3%, Johnson & Johnson at just under 3%. Then we have Procter & Gamble, Chevron, Home Depot, AbbVie, Merck, Eli Lilly, and Bank of America. The top 10 holdings make up 23.48% of the fund, and it contains a total of 443 holdings altogether. Very diversified fund. Now, in our public portfolio I've been building since we started the channel 6 months ago, I've been buying VYM in equal amounts with SCHD, kind of an experiment. I thought that was a nice balance, and since this, the funds have performed almost exactly the same. It's pretty crazy really, but we'll see what happens in the future. I plan to continue the strategy VYM at least through the end of the year in that portfolio, and the next video will be out on that soon in our monthly portfolio summary video. All right, the second ETF is the iShares Core Dividend Growth ETF, ticker DGRO. DGRO tracks the Morningstar US Dividend Growth Index by using a representative sampling technique. Year to date, shares of DGRO are down around 1.3%. And over the last year, shares are down about 10%. And we'll look at the longer term performance up against VYM and a couple others shortly. Now, DGRO meets my criteria for expense ratio at only 0.08%, slightly higher than SCHD and VYM, coming out at only $8 for every $10,000 invested every year. And to me, that's acceptable for a high quality fund. Let's look at the dividend. SeekingAlpha gives DGRO an A for its dividend grade, and the trailing 12-month dividend yield for DGRO is 2.47%. In the last 12 months, investors received $1.20 per share. This is a fund focused more on dividend growth than high dividend yield. DGRO has an impressive dividend growth track record, which is what we would expect from an ETF that uses a bold tracker called DGRO. Their dividend payout has grown by double digits annually over the last 5 years. That's at 8 years of dividend growth. Well, DGRO was started in 2014, so this dividend's grown every year since its inception. The last dividend payment was made just as I record this video on March 29th. And this is another March, June, September, and December payer. Very standard. Here on the dividend yield page in SeekingAlpha, we can view the 10-year yield chart. And this is one that likes to hang out in the low 2%. Sometimes it dips below that. Had you purchased shares when DGRO first became available for investment, those shares would be paying out about 4.7% of the initial investment. And that is a respectable yield on cost. And this dividend history chart puts the data we looked at into another perspective. Just looking at it, it looks like being able to get shares above that 2.1% yield, you're probably getting them at a decent price when it's above that. And here is DGRO on the dividend growth tab. In 2018 and 2019, the dividend grew by nearly 15% each year, and last year it had grown by 9%. So I'd say in the selection process of this Morningstar US Dividend Growth Index is doing its job so far. Now here's how the diversification breaks down for the DGRO ETF. Healthcare makes up nearly 20% of the fund, followed by financials and technology coming in at second. Industrials and consumer staples both around 11%. Utilities and energy around 7%. So just like SCHD and VYM, no real estate. And I'm thinking this must be for tax purposes to keep the dividend payment qualified. Now here are the top 10 holdings in the fund. The top 2 are the same 2 in the S&P 500. We have Microsoft, and Apple, making up more than 3% of the fund, followed by J&J, Exxon, AbbVie, JP Morgan, Chevron, Pfizer, Procter & Gamble, and Home Depot. All in all, there are 449 holdings in DGRO, but those top 10 I listed make up 26.55% of the fund. And between VYM and SCHDs, there's a lot of overlap here in DGRO, so that's kind of why I've stuck with the other two so far. But I do think there is a lot of appeal here for dividend growth investors. The yield is a little lower than some of the other options, but the dividend growth rate is encouraging. And I've long been considering adding it into my mix somewhere, just another option to keep you more diversified. ETF number 3 is the Vanguard Dividend Appreciation ETF, ticker VIG. VIG is another Vanguard fund that aims to track the S&P US Dividend Growers Index by using a full replication technique. Year to date, VIG is about flat, and this is outperforming SCHD, which is down about 4% year to date. Over the 12 months, VIG is down just over 7%, and this is outperforming the S&P 500 by 5 points, and even slightly outperforming SCHD. As we expect with a high-quality Vanguard fund, the expense ratio is extremely low, 0.06%, and that's $6 for every $10,000 invested every year, same as SCHD and VYM. So it seems like 0.06% is about as low as we can get for a good dividend fund. And this fund is focused on dividend growth over dividend yield. You aren't going to get quite the dividend here that you're getting with SCHD or VYM, but at the end of the video, I'll show you which of these have performed best on a total return basis, and that's really what I'm after as a long-term investor. Now, VIG has a trailing 12-month yield of 2%, and they paid out $3.03 over this last 12 months. Over the last 5 years, the dividend payout from VIG has grown at a rate of about 10%, so this fund is working as advertised with 9 years of dividend growth. VIG is paying out just as I released this video. They're on March 29th, 2023, in the amount of 75 cents per share. Like all of the others we've covered in this video, this is a March, June, September, December payer. That's one potential downside of going with an all ETF route, is the majority of your dividend income will come in quarterly in the same months. Now here's a look at the 10-year yield chart in Seeking Alpha. The current yield is about 7% lower than its 10-year average. Although if we look at this from just the last 5 years, the yield is 6% above the 5-year average. And for a long period, this dividend was well below a 2% yield. Now, some wonderful grades from Seeking Alpha for this ETF, straight A's across the board, and an A+ for its dividend grade. Let's look at the 10-year yield on cost. If you had purchased shares of VIG 10 years ago, you'd be getting back 4.6% of your initial investment. That's more than double the current yield of VIG, and shows why it's important to hold these types of investments over long periods. Here's a chart of VIG's yield history. The average dividend yield in recent years does hang out below that 2% mark, so getting this above a 2% yield looks like a good opportunity to me with that 10% year-over-year dividend growth. Speaking of dividend growth, here is the Seeking Alpha charts on dividend growth. Last year, the dividend grew almost 12% over the previous year, and it'll be exciting to see how this pans out over 2023. As far as its holdings breakdowns go, this is another financial-heavy fund with financials making up over 1/5 of VIG, followed by 17% in technology, 15% in healthcare and industrials, and 13% in consumer staples. No real estate exposure as with the others, and one unique thing about this one, there's also very little energy exposure. Now here are the top 10 holdings of VIG. United Health Group is its number 1 position at 3.71% of the fund, followed by Microsoft, JP Morgan Chase, Johnson & Johnson. These all make up close to 3.5% of VIG. And rounding out the top 10 are Visa, Procter & Gamble, Home Depot, MasterCard Inc., Broadcom, and PepsiCo. A lot of SCHD, DGRO overlap in this top 10. And they're also, these 10 stocks, they make up 26% of VIG. And there are 292 holdings in VIG overall, which make up the remaining 70-ish%, okay? So that's 3 solid alternatives to SCHD. None have performed quite as well as SCHD historically, but now let's put them all side by side using Seeking Alpha's Peers feature. This is a useful way to compare stocks and ETFs side by side real quick. It really helps to see the pros and cons of each fund. So I have all 3 of our ETFs set up here next to SCHD, and really this is just going to show why SCHD is the king of dividend ETFs. Now, DGRO has the highest expense ratio, but all of them are acceptable in my book for what they do and how they perform. These have all done pretty well. Scrolling down, we have all 4 of them plotted out on a graph here. SCHD is the orange, VYM in blue, DGRO in purple, VIG is in this green color here. This is comparing in terms of price return, but I think for a dividend ETF, it's useful to look at total return, so it takes into account dividends paid as well as price appreciation. So VIG has been the winner so far of 2023, but let's zoom out some. Looking at the last year, total return, we have extremely similar performance across the board for all 4 of these funds. All are within a percentage of each other, down around 5 or 6% over the last year. Remember, this accounts for that 2 to 3% dividend each of these have paid out. And we are long-term investors here, so let's zoom out more, looking at 3 years. This is where SCHD really starts to separate itself as the clear cream of the crop, returning 74% over the last 3 years, while VYM and DGRO have returned about 60%, and VIG has returned about 52%. Let me scroll up here. I'm going to add in an S&P 500 index, so we have a benchmark of the total market. This will demonstrate something. Since now we have a 5th line here in red. So over the last 3 years, the S&P has outperformed all of these funds except for SCHD. SCHD has greatly outperformed the S&P over the last 3 years. Look at that. And notice that the S&P's outperformance of both VYM and DGRO are only about a point or two, pretty negligible. Now what happens when we look at a 5-year total return? SCHD is still the top performer with 75% total return, which beats the S&P 500's 69%. And coming in at second now is VIG at 67%, very close to tracking the S&P's performance. VYM's performance, however, drops dramatically down to 50% over that time span. But let's look at 10 years, and things look different again. Now, S&P 500 is the winner, which is what we should expect over a decade stretch. It's pretty freaking hard to beat the market, but SCHD is hanging in there with a sweet 211% total return that's just a couple points less than the S&P 500. And coming in third is VIG at 184%, VYM at 161%, and DGRO at 141%. And to be fair, DGRO doesn't go quite as far back as it's only 9 years old. So the performance varies depending on how far back we look, right? And this leads me to a couple conclusions. As we zoomed out, really invest in the S&P 500 is what I think is most important. If you're a long-term investor, you want to maximize performance, don't try to beat the market. And look, VOO only has a 0.03% expense ratio. It's lower than all of these. Not quite the dividend of the others, but this is what's going to really grow your money long-term in this sort of fund. And it's really difficult to beat that. If you have time, S&P 500 is a great place to be. Second, SCHD is one kick-ass dividend ETF, and it deserves all of the hype it gets. And third, there are some fine alternatives we looked at today that do provide some extra diversification, and past performance doesn't guarantee future results. It's important to keep that in mind. We can continue to compare these. I think Seeking Alpha here is a great site, and if you're interested, just be sure to check out the link in the bio to get a discount on their premium membership. You can help support our work on the channel. We're just going to end the video here, guys. I have a couple more coming here in the next few days as we're at the end of the month. Namely, we're going to be reviewing our portfolio for March that we've been building up here on the channel. I have some picks for the month of April that I like for dividend growth stocks that I'm going to share with you guys. We'll go a little in depth on some picks. And also I'll have my Roth IRA update. We are now at Q1. Talk about the REITs I bought. And so that's 3 videos I got to get out in the next week here. I know I put out my videos in spurts. I've been going through somewhat of a creative block and had a hard time making content over the last 10-day stretch. So I appreciate all of your patience with me as I work through that. But I do hope you found value in today's video. So please, if you did, like and subscribe. That really does help us out. And until next time, my friends, keep investing.